markets are surging, and here to talk about it is Alec Young, Managing Director at FTSE Russell. Welcome.
Great to be here.
So we are post-elections. What's going on with the markets and the economy?
Well, it's certainly, I think, a relief for markets just to get through the uncertainty of who is going to win the election. There are certainly other bigger macro issues out there besides the politics, but I think investors are breathing a sigh of relief just to get the uncertainty over with. So not surprised to see a positive tone in the markets today after the election. And I think another positive force that people should think about is the idea that now that the president has lost the majority in the House of Representatives, it may be a little bit more difficult for him to push through stimulative legislation now that he doesn't have control of both houses of Congress. So he may be more inclined to compromise and do a Chinese trade deal, which obviously is a big macroeconomic focus for markets, some sort of positive momentum with the Chinese on trade. The president, now that he's less likely to get legislative breakthroughs, may be more reliant on trade as a way to stimulate the economy going into his reelection bid in 2020. He'll want to be campaigning on a strong economy, and trade is a fairly effective way to stimulate the economy without having to go through Congress and worry about spending a lot of money. It's a fairly cost-effective strategy, but there's a lot of uncertainty in the business community about the potential impacts of trade on the business environment. So if the president is able to make some inroads with President Xi at the G20 at the end of the month and beyond that, it could certainly help the economy through improved business sentiment. So I think that trade outlook may be a bit of an underappreciated reason that stocks are reacting positively to the electoral news.
Do you think his proposed second tax cut is in question right now?
I think so, yes. That, I think, would have required the Republicans to maintain control of the House, as well as the Senate, which obviously they still control. But I think they would need to control both houses. I think the betting at this point is that tax cut 2.0, as it's being called, is probably going to be more difficult. Infrastructure may be something that the Democrats and Republicans can compromise on. But again, I think investors are really going to be very focused on Chinese trade. There's been signs of increasingly tight financial conditions, and that's driven increased volatility in the markets, concerns about slowing Chinese growth at a time when the Fed is continuing to tighten monetary policy. So from a macro perspective, I think markets are very focused on trade. And so I think the president is very conscious of that. And so it'll be interesting to see how that topic develops over the next couple of months.
And going back to today's market action, two sectors are surging, healthcare and technology. What do you make of this?
Sure. Well, we've tended to see the tech sector really as a bellwether on people's optimism on economic growth. So tech has done well all year. People have been fairly optimistic about the economy. Recently, we've seen some aggressive profit taking in tech, and healthcare has many of these same components, especially in areas like biotech and medical devices. And those growth-oriented sectors have seen some profit taking recently as people have gotten concerned with slowing global growth, obviously led by China, trade uncertainty at a time when the Fed is continuing to tighten steadily. People have been concerned about a possible policy mistake. And so we've seen profit taking and growth. I think now, given what I was just talking about with the election and the trade glass maybe being half full as a result of that, it's not surprising to see life being breathed back into some of these cyclical sectors. And technology and certainly the healthcare sector outside of big pharma, which tends to be a little higher yielding and more defensive, but all the other areas of healthcare tend to have more cyclical properties than a lot of people realize. So not surprising in a pro-cyclical tape to see strength in those areas.
And you mentioned the Fed. The committee is meeting today, ending the meeting tomorrow. Any expectations this time?
No, I think the markets are generally expecting a good chance of a rate hike in December, but nothing's expected at this meeting. And I don't know that we'll see really any change in the guidance, which has really been to continue to watch the economic data, but basically expecting steady rate hikes, move in December, 3 moves next year. I think it's too soon to expect the Fed to get more dovish. They would need to see either much more volatility in the capital markets or greater signs of economic weakness. And we really haven't seen too much of that, enough yet, I think, to get the Fed to change its tone. So not really expecting any major headlines out of the Fed. But of course, given how important psychology around Fed tightening is in the market right now, people will be parsing every word of the Fed statement.
When you look at broader market, more long term, what do you see? What do you think is driving them? And how do you think investors could play this environment?
Well, I think the big thing looking out into 2019 is really the sustainability of global economic growth, profit growth. There are signs certainly outside the U.S. that growth is slowing. Even in the U.S. it's been strong, but there are signs of deceleration. Leading indicators are slowing down. So I think it's difficult also with the strength of earnings this year to expect the same kind of growth next year. The comparisons will be difficult. So overall, we have a macro environment where growth is going to be slowing in the U.S. and internationally. Earnings growth is going to be slowing. And a lot of that risk has been part of why markets have corrected a little bit. Another big issue is really what the Fed is doing. If growth is slowing, I think markets want the Fed to be a little more dovish. If the Fed's continuing with steady rate hikes at a time when markets are slowing, that's a bit of a concern. But we've seen valuations come in and reset lower to discount many of these issues. And I think we're going to continue to watch financial conditions, things like dollar strength, credit spreads. These are good indicators as to whether risk appetite is increasing or decreasing. But I think overall, it's really about how much does growth slow into 2019 and how does the Fed respond. Those are the big things that I think are going to determine how well stocks do, not only in the U.S. but globally over the next 12 months.
Thank you so much.
Thank you.
My guest was Alec Young, Managing Director at FTSE Russell. I'm Alexandra Michalska, and this is Reuters.